Hello, everyone. Welcome to another episode of Tokenizecast, the series of podcasts where we talk about emerging technologies like AI, Web3, and blockchain, and think about how these technologies are shaping our future. And I'm very happy to introduce our guest today. He is the researcher, educator, and innovator in this field of blockchain and decentralized finance in general. Nitin Gaur, he is the head of digital asset and engineering in oh my god. Okay.
It's okay. It happens to me all
Sorry.
the time. We can start again. That's no
Yeah, I'll
worries.
start again. Yeah. So head of digital assets and technology strategy, right? Digital assets and
Technology design. It's
technology
global head digital
design.
asset is you can just keep it digital asset global head digital asset is fine to keep it short.
Okay, yeah,
No
global
worries.
head and digital assets. Okay,
Yeah.
perfect. Yeah. Okay, recording again. Hello, everyone. Welcome to another episode of Tokenizecast, a series of podcasts focusing on emerging technologies like AI, blockchain, and also think about how these technologies are shaping our future. And I'm very happy to introduce our guest today. He's an educator, innovator, and a researcher in the field of digital assets and decentralized finance and blockchain in general. He's a very vocal supporter of blockchain technologies for some time now, and he not only established but also implemented many enterprise applications of blockchain. Happy to introduce Nitin Gaur, who is the global head of digital assets and technology design at State Street. Welcome, Nitin. Great fan of you. Looking forward to have this conversation.
Thank you so much, Ganesh Ram, and I'm humbled, but also thank you for the kind introduction. And this goes both ways. I'm quite a big fan of what you have done, at least laying bricks by bricks and moving the industry forward. So congratulations to you and to Relevance for all the work that you've done for the industry. So looking forward to this conversation, and really glad to be here. Thanks for the invite.
Thanks, Nitin. We are following the trials that you blazed for us.
Thank you.
So, I would like to start with decoding digital assets tokenization, right? So, two parts to it: digital assets and tokenization. What are digital assets? What qualifies to be digital asset, Nitin?
Yeah, and that's a great question because oftentimes it's confused. So if you look at digital asset management, it goes back to anywhere written what we have done with Maximo and Tririga. These are the products that were creating digital twins. They were creating a digital manifestation of things like your parts repair, and what the automotive industry and the space industry has been doing for ages is creating digital twin, which gives them similar to what you've seen in movies. So I wrote an article on this, is the shift from digitization to tokenization, right? Essentially, the fact that you're dealing with moving money digitally, which is what we do, Zelle and FedNow, which is a recently announcement, and ACH and Swift. These are all using digital technology and essentially moving ledgers, except that it's not the most efficient way of doing it, and it doesn't really gel well with where things have been sort of evolving from the velocity and veracity of transactions we process. So digital assets in general are, again, either a digital twin, digital manifestation of physical asset, or a digital native asset itself. So, for example, I would also classify your iTunes music as a digital asset because you are paying for it and you value it, whether the value is intrinsic, giving you joy of listening to it, but it's transferred and transmitted through digital channels, just like our digital currency and digital, value that we transfer using existing rails, as opposed to tokenized assets, which takes a different shape or form, Ganeshram, where I think that the fact that a music can be replicated, which is the business model of any of the music record companies, where you're able to create a asset and you're able to replicate the music, and same thing with with many of the technologies that are involved in creating digital twins. The only difference I would say that tokenized asset provides certain element of the asset tokenization technologies that define a native tokenized asset per se, which is inability for you to be able to replicate the asset, inability for you to be able to copy the asset multiple times and make certain copies of those assets. But more importantly, I think there are some elements of things like non-repudiation, which is the fact that with certainty, I can take a tokenized asset or token that represents an asset in its native form and move the assets through the digital channels is where the shift is. And I'll say one more thing and I'll pause and get your perspectives, Ganeshram, as well, is if you look at the evolution of our existing financial system, we started out with, again, paper-based movement of assets. Whether you could go back to the old day of DTCC, you had stock certificates, you had mood stock certificates, you had all these messengers who would consistently move. Eventually, when we moved towards internet, we were able to find connected channels. And we have come to a point now that we are looking at tokenized assets in general. And that evolutionary sense really is driving this conversation where the velocity of velocity of transaction growth, the amount of people who are in this world, and the need for much more instant way of dealing with the asset, which is essentially what is driving this movement of going with tokenized assets, because there's no notion of clearing and settlement and multiple conversational state that today we have to go through to be able to reach a settlement finality. The whole idea behind tokenized asset is like me sitting in front of you, and if I were to give you a $10 in cash, that's settlement. There's no back office function, and we want to be able to create a digital manifestation of that transaction that is equivalent of me giving something to you if I were to meet you in person. And so I'll pause at that to see if that made sense.
Yeah, there is a lot to unpack in that definition,
True.
Nathan. Yeah, so listening from you, I understand that the digital assets has been around for some time. You pointed out the example of music, for example. So that is digitization, and what is tokenization then? What's the difference between that?
Yeah, the difference between that is that, again, I can replicate the asset multiple times. I can replicate the historical sense of digitization is based on binary technologies, which allows you to be able to cut and paste, essentially, right? You're able to copy a music. You're also able to copy ledgers, which is what we do behind the scenes when we replicate multiple databases for sake of high availability. But databases essentially are your a record keeping of your asset, which is a part of the transaction system. And the way we are moving those assets across the system, whether it's domestically or whether it's globally, is we are using various transaction technologies, various middleware technologies. There's a lot of mainframes behind the scenes that process transactions. Process transactions meaning that if I'm sending money to Ganeshram, or if I'm moving and buying and selling assets, I'm not only selling my assets, but I'm also receiving funds in return. And there is a connection between those two assets. And the way we achieve that is we have a set of technologies that allows us to be able to record the ownership, which is essentially what ledgers do. And you move the ownership, and every financial institution is responsible for ensuring that their books on the order and they move. So you're still replicating these values in your ledger, and you're eventually moving the replicated value to other ledgers, and they have to reconcile and ensure that they're able to realize the value that is either moved to them or from them. And in doing all these things, you have people, system, technologies, investments to ensure that the records are straight, which means if I'm sending you $100 and I have $200 and the books reflect me having $100 and you having, and the movement of $100 from me to your account, as an example. And what digitization has done is we have sped that up. It's no longer paper record and you basically reconciling book between financial institutions, or essentially doing a netting function, which basically sum totals all the owner, all the asset that it has to move to the other side and provide a record of that, of that entry. Tokenization in general further makes that process more efficient, where token movement is the ultimate settlement. So if I'm moving a token, it's like me moving cash from one book to another book. And there is no reconciliation needed. There is no sort of back office function that is ensuring, like we run multiple batch processes that takes 8 hours in most cases, which is why it takes a full day for you to move assets. Suddenly you're moving towards instant movement of money, instant movement of assets. And this instant settlement or instant movement of assets in return of instant movement of money increases velocity of our economic systems. So imagine if I send you $1 million and the $1 million takes 2 days to reach to you because they have to do all this verification, validation, and ensuring that my books are in order for the sake of liquidity management and so on and so forth. Now, the cost of the locked capital, right? For example, I have suddenly now $1 million, neither yours nor mine, but it's in the system. You're not able to use it. I'm not able to use it. and the system actually has to reconcile itself to be able to make it available, for you. That has a cost. That has an economic cost. That has an opportunity cost, and someone benefits from this liquidity system that's in the place. But with tokenized assets, I don't have to deal with that. It's almost instant, and velocity of those transactions has a ripple effect on the overall economy, that suddenly now assets are more easily available. There is more liquidity through the system. And suddenly now the velocity of the transactions and velocity of asset movement is at a much faster pace. And that leads to economic growth. That leads to, again, a lot of unlocked capital, potential of capital, which today has been evolving over time. Early on, it used to take 3 days to settle. Sometimes it take a week to settle. We are at a point with FedNow and Zelle, which is almost end of day at a banking level. But I still think that with tokenization, we're able to reach a whole new level that it's not just me sending money to you. I'm able to engage in things like duality of a transaction. I can do atomic swaps. I can make sure that I can have systems, which is what we are trying to do in blockchain world, smart contracts, that you're able to do things like DVP and PVP, that if you're able to sell me an asset, we have an escrow system, and we are able to ensure that we are managing the money in both directions, or managing the movement of assets in both directions. That's where we're heading towards. So it's not just about the speed itself, it's about efficiency. It's about all the intermediary services that the companies that me and you work with and work for are in business of. They're in business of trust. They're business of providing this intermediation services. But if we are able to provide the same level of intermediation through codification of that system using DLT and blockchain and smart contracts, I think it reduces massively the cost of transaction processing and transaction cost, which is a big portion of the fee structures that we all pay to participate in this financial system that we're in, I think.
Mm-hmm. Mm-hmm. Yeah, I think, you put this nicely in one of the articles, that tokenization is essential to solve the problem of inefficiencies in time and trust, right? So
Correct.
that's really what we touched upon, I believe. So, and applied to the context of the cash, Nitin, and I'm able to understand all of this, but digital assets are not just confined to cash as
Yep.
the asset, but we are talking about securities, private equities, real estates.
Yep.
Are those really digital assets as well? Do we have the same problems there?
Yeah, we do. In fact, the problems are greater. So, and I've always said this, Ganeshram, that you cannot solve the transactional problem of digital assets. So we've been talking about tokenization of money market funds, tokenization of private markets, hedge funds, ETFs, gold, silver, precious metals, all the asset classes. So generally there are 4 asset classes that the industry defines, and we begin to look at crypto as 5th asset class. And you cannot tokenize all these things and not tokenize money, because money provides the fungibility. Money provides a medium of exchange that no matter what you do, I'm able to measure that in dollars or euro and yen and so on and so forth, right? So there's an element of the settlement that the fungible instruments like fiat or cash provides. But as we are tokenizing these assets, the problem is grave, because you have commodities, you have securities, and you have different types of securities. And securities have to be backed by certain guarantees. And these guarantees today are defined by a legal framework, which is trapped in PDF files. And all we're doing is tokenizing those PDF files and providing a linkage to that original document that has verified and validated through a legal process that defines an asset per se. And so it is essentially you're inching towards a model where the financial market infrastructure, the infrastructure that maintains, that me and you are able to go to a website and be able to buy equities and participate in various sort of derivative assets and pledge our assets and borrow against our assets. All these are what I call as financial primitives: lending, borrowing, collateral management, movement of equity. These are basic element that is the foundation of all financial instruments that are around us. And the question then becomes is, if you're able to tokenize these things, and you mentioned time and trust, which is my favorite 2 terms, is if I'm able to move this with certainty and guarantee that this represents an asset and the asset is confirmed, and I am ensuring that the asset reaches to you with guarantees that I will be paid in return, and I'm able to do this in real time. So I'm not only closing the gap of time, which has implications of liquidity management, of locked capital potentials, and so on and so forth, but also trust that suddenly now I'm bypassing various financial services intermediaries who are in between, who are charging a fee for me to guarantee that trust, which today it can be guaranteed through protocols. right? So it has to be a complete financial system. We cannot only solve one leg of that equation and leave the other leg open. It has to be, and slowly we are doing this. We're doing this for various asset classes. I personally have been involved in syndicated loans and money market funds and ETFs and gold, also cash with CBDC stable coins. So you see this ripple effect, the slowly the wheels are turning, that every asset becomes a potential, and people are finding that a loan that takes syndicated loan takes 27 days to settle, as you know. It shouldn't be 27 days, right? It has problems. For 27 days, we don't know the fate of the 100 million or $1 billion loan. And that if you have hundreds of loans, it's a systemic risk because we don't know where the liquidity is going to move, the movement of liquidity through those lending process, right? Same thing with commodities, right? Commodities may take a longer time than to settle. Private equity is even worse. It's all paper based even today. Even though we are in this super digital world, it's all driven by PDF files, and files are being moved around. So we've digitized in a sense, but the PDF file still requires signatures. And yes, we've DocuSigned the whole thing, but it still takes anywhere between 3 months, 4 months, and there's no secondary market. So if you invest into a private equity model or private equity investment, you simply have to wait till that matures. And sometimes that can be 5-10 years. So you have your capital is locked for 5-10 years. There's no secondary markets. And once you tokenize it, suddenly you have the avenue to be able to trade that token that represents a private equity instrument into, let's say, a ATS, alternative trading systems. So you can see as to how it sort of has a downstream impact of creating secondary markets for assets that simply don't have secondary markets, on bringing liquidity to the markets that don't have liquidity, and simply making the process more efficient and more visible. I'll pause here because I could go on as you know.
But what does this mean to the business process or the infrastructure, right? The reason why I'm getting to this is, listening to you, I partly get a sense that Ganesh, we have to roll it out all together in one big bang, or maybe we cannot do it incrementally because it's not efficient. The velocity mismatch between the assets and cash will be there. So is there a long wait time for all of this to be tokenized and rolled out together, or can this happen incrementally? How will that impact the business process and the infrastructure?
That's a really hard question. You hit the nail on the head in terms of the question itself is brilliant. And me and you both have spent almost a decade figuring this out, right? Because today, and I was involved in BPM, business process management, and you have been doing this work when we had middleware and we had back office system, they had workflows designed to be able to make this process more efficient. So the existing process, whether it's a financial institution, investment management, wealth management, asset management, they all have some workflow, and that is their business process. So when you open an account, there's onboarding, you put money in there's a deposit goes to an account. All this is nothing but a business process. Blockchain is a network, and blockchain flattens that business process onto a single layer. So right now, when you send money from A bank to bank A to bank B, or you send equities from bank A to bank B, bank A has to follow its business process. Message goes to bank B receives the message, follows its business process, which is what essentially is the issue of time. It takes time to do all these things because they all have human intervention, long running process, and short running process, all these stuff that we have designed over time at the era where we had to make it more efficient, which is where we are today. But when you bring in blockchain, you're flattening the business process to a single network. So essentially, bank A is on the network, bank B is on the network. There's no more messaging. I'm simply sending a token. This token has to be processed by a smart contract. It's almost instantaneous. And the smart contract eventually processes the token. And if everything is okay, they move the token to bank B. It's the same business process. There is no longer the strapped sort of element of business processes across the entire financial system. And an average asset takes about 6 to 7 hops, unless you're doing a direct sort of transfer between two financial institutions. Wow. So you can see so what does a bank do? And I actually wrote my recent article on this topic too, is you cannot throw away their existing business because that's running your business. There's still a $471 trillion economy that runs on this of the sum total of all the bankable assets in all of the world, and all the banks are involved in measuring and valuing and engaging in financial primitives like buying and selling and borrowing and lending. you can't throw that away because blockchain is cool, because you still have to deal with managing your business, and these systems, the old business process system that me and you have built, are managing your business for a bank or for a financial institution.
Yeah.
So how do you coexist? And until you solve two issues, and this is something which I've highlighted after 10 years of research, though it sounds very simplistic, but there's a lot of technology behind it, is a harmonized operational framework. So if you're sitting behind the desk as an employee of the bank, you shouldn't have to worry if it's a stable coin or a CBDC or a simple ISO 20022 payment that you've received from the other bank. You should be able to process it like you would normally process it and record the processing into your cash management, treasury management, payment systems like you normally do. And that's true for all asset classes. You're dealing with securities, there's a broker-dealer network, there's a custodian, you're moving securities. All the process that we do now, you have to coexist with the old. Otherwise, it's going to be too expensive, too confusing. And that's why an average project today lasts for a year and 2 months, $1.2 million, and they always fail because they have completely ignored the operational aspect of the financial system that we work with. So I have some opinions on that, but that's one angle. Second angle is interoperability. Interoperability between the old and the new. So the old system is pretty much all driven by messages. So you have a database, sends a message, you have assurance of message delivery, and then you deduct the amount to your database, and that's a transaction processing that happens through this business process system that we talked about, which is linked. And then you have a challenge that allows you to be able to shift towards a tokenized model, which removes all these processing challenges and move the assets. And you have to interoperate not only between the old and the new, the messaging system and tokenization system, but you also have to figure out interoperability to say that your partner bank may not be using the same blockchain protocol that you're using. They may be using a different protocol. And if they send you an asset that has emerged or emanated from a different protocol, and you have to custody it or you have to accept the asset, now I have to resolve the asset and deal with the interoperability at protocol level. So it is a huge technical burden or technical debt, as I've always called it. And the challenge is to find the balance between operational harmony and managing technology debt, because when things become too expensive, then you don't get to diminishing rate of return. Then it becomes too expensive, and every time you add a new asset class, things become more and more expensive. And at some point, we're trying to solve a business problem here. It's not just about tokenization because it's cool. We have to make sure it's cheap. It's cheaper, faster, and better, if that makes sense.
Yeah, really, yeah. And speaking of interoperability, right? Yes, one is interoperability with your decentralized system and your incumbent system that is already keeping your business up and running. And the second interoperability is within blockchain networks of Bank A and Bank B. So will we run into a situation of whose blockchain is this, Nitin? Because what happened to the central philosophy of decentralization, having no one single central entity? But here we are talking about every parties involved having their own blockchain and interoperability between them. But is that the true blockchain notion at all, to decentralization?
That's another follow-on question, which is a problem that the industry is dealing with. If you look at the blockchain ecosystem, there are 800 blockchains plus, and every day there's new one popping up, because the cost of producing blockchain is becoming a lot more simpler, because all you're doing is cutting and pasting the code and making a few small changes and calling it different, right? And then you have the enterprise world that has to deal with figuring out which is more superior. Unlike the old system, we had Java, we had JMS, the messaging system that Java had interfaces with. We had messaging standards. We had representation of messaging, whether it's XML and JSON. You had all this tech standard that evolved over a period of 2 decades, right? We had almost 2 years to 20 years where, you had J2E and Java evolved, and you had transaction systems evolve, and you had figuring out what's the best and most efficient way to send messages. But messages were always there during EDI days. This is even pre-existing SES, EDI is electronic data interchange. Which allows us to be able to send a certain format. And before that, we had telex. If you, maybe I'm dating myself, Ganesh Ram, we used to send a few messages through telex, which was paper-driven through faxing. So there's always a value in standards and formatting,
right,
which is not there in crypto today. Well, there are formats, because blocks are nothing but formats, but it differs from every blockchain to blockchain. ecosystem. And while the industry navigates between figuring out and settling on standards and figuring out the right message formats, I think we begin to see some incumbent systems which are, so EVM compatibility to me is to say, okay, fine, if you have disparate blockchain systems, somehow I can have the code, which is smart contract, portable. So I can have the smart contract run in multiple places, which at least does the verification validation of my asset, my tokenized asset. So there's a hope there. There's a hope in ERC, which is Ethereum response for comment, with like RFC, where you have defined asset tokenization standard that defines you the way to construct your asset. There are constructors that allows you to be able to define how your asset should represent itself and how the smart contract should handle the assets. And then you have various chains who are, because of the momentum behind the Ethereum ecosystem, they are building compatibility avenues to both EVM, which is the runtime capabilities, but there's also an element saying, can we simply adopt because there's enough momentum behind? And these are essentially how standards are evolved, even though they're not a W3 or ISO standards, but it's widely accepted that let's go and adopt these things. I see that as a hope. I see there's a hope where we can adopt. And this is what I'm doing my day job too, is figuring out which is the most adaptable and consumable sort of standard that I can piggyback on, so I can reduce my technology debt, that I can then talk to my cohort and our customers and say, hey, we are working on ERC 1400 or 3643. And if you're working on that as a security token standards, then we can shake hands and we can then consume this. So I'll say one more thing, Nishant, before I pause. Broadly speaking, I've defined the industry into 3 I's, right? Infrastructure, which is blockchain ecosystem, and I can have my own, and JPM has their own with Onyx, and Goldman Sachs is building their own. So there'll be no one blockchain. I don't think that's going to be the winner. It's a utopian sort of concept. Everybody's going to have their own infrastructure. And this instrument, the second I, which is I can have a token that represents security, gold, silver, precious metals, fiat. A token is a token is a token, but I have to resolve the token into what it represents. So that's the second I that I have to deal with. And the third I is insights, which is using AI and machine learning, because the velocity and veracity of data and transactions, I cannot use a manual system to analyze this entire infrastructure. I need a much more real-time system, and I have to rely upon machine learning of sorts to be able to do business analysis and financial crimes and so on and so forth. So that's how I've classified the industry as 3 I's. What is the infrastructure do I need? Which instruments am I dealing with? And what is the system that I need to analyze the entire transaction system, so I can actually transact with proper guardrails and operational controls.
And the AI and the machine learning is for the guardrails and controls.
Correct.
That's right.
I think it becomes essential at some point. I've done enough research analysis on this topic, Ganesh Ram, where today only 45% of financial crimes are prosecuted, even though we have enough tech, only because it's an old system and they're relying upon, at the end of the day, you're connecting the dots and finding patterns. So suddenly now Treasury or some agency will go and ask 10 financial institutions to provide information about one transaction. That takes time. Blockchain is a linked list. I can always go and map and connect the dots and find patterns and do this in real time while transactions are happening. And that gives enormous power for me to be able to do things like compliance and KYC and AML. I cannot rely on old systems to do it because they're completely inefficient and they will fall short of delivering the value, I think.
Excellent. And we have been talking about tokenization in the context of B2B so far, I think. I'm very curious to know, what will it mean to me as a consumer, right? So will I ever come in contact with tokenized asset, or that is more of behind the scene operations, or how will that look?
To me, if people keep asking for killer apps, Ganesh Ram, to me, that's a killer app that consumer doesn't even know, but you're dealing with blockchain. So you're going to go to ATM. Of course, we work with the technology behind the scene. It still ties to your core banking system. You have a machine. Some of them are running Windows. Some of them are still running OS2, which is like a really old IBM operating system in Japan, for example. But no one cares. You go to an ATM machine, you withdraw money, you get the cash, and you're done. But behind the scenes, you have all kinds of old and new technologies who are passing messaging and passing information, so you can have your cash available to you, right? And so ideal use case would be that no one cares, but you're able as a consumer to see the benefit of, again, time and trust is cheaper, faster, better, that you can move the money in near real time, like we can do today with stablecoin. If you need to move stablecoin in India and if you have the wallet, or I have done this in various experiments that I'm able to send $10,000 worth of stablecoin, for example, from here to Germany in almost instantly, which is not the case today with sending $10,000 using a banking system. Right. And so as a consumer, you should never know. It should be all behind the scenes. It's all back-end technology, but you should feel the effect of it because it's cheaper, faster, better.
Yeah. So they will see the efficiencies of time and trust there,
Correct.
but not really understand what's going on behind the scenes. And this is something that I always wanted to ask, Nitin. Tokenization has been around for so long, from the days of CryptoKitties, and what took it so long to come to such a limelight? Is it just too difficult a concept to understand, or was that the limitations of the technology? What is stopping the adoption of it? It is such a beneficial concept. Are regulators playing the role here? What is slowing this down?
Yeah, so there's multitude of things, right? One is, and actually tokenization goes way back. Your SAML tokens, like when you log on to your site and is accepting Facebook or Google identity as a service, that's sort of a token. I used to work with Data Power, which was a on-premise device to do message formatting, which working at IBM, we had this massive financial system that led upon transformation of certain messages to certain message standard to reduce the cost of upgrading the system because they were old systems per se. They all use tokens. We use token today in your API keys. All these are all tokenized technologies, right?
Based on web
so the only difference is the verification validation system of these tokens that ensure the token is unique. It represents a certain value. Second thing is our existing financial system, Ganeshram, has evolved over hundreds of years. And believe it or not, every financial system is regulated, including your payment system. It's regulated by FFIEC in the US, and you have similar bodies around the world that regulate payment systems, that regulate. And so whatever we build has to adhere to availability and resiliency standards that existing systems do. So I recall building payment systems, we would spend 2 years testing and ensuring that nothing goes wrong with these payment systems because your economy relies upon it, because you're moving money at an exponential scale, especially the central bank systems. And same thing with Visa, MasterCard systems. These are global systems. And we have seen some failures, like we've seen recently in Europe, in UK, where suddenly now the CHAPS, which is their RTGS system, was down and people couldn't use their bank accounts to transfer money or buy things. So it has a massive economic impact. I think whether it's the generational element that the regulations are the regulators are looking to say, if you're doing all these things, we want to make sure you're adhering to the same security standards to secure the infrastructure. Cybersecurity threat is at the most. You've seen that today with your energy grids and your hospital systems, and so cybersecurity is treated as a big issue. And as we are moving this to a tokenized world, the cybersecurity perspective on these infrastructure is very, very exponentially high. So the regulators, and rightly so, they want to make sure that the systems are protected, it's resilient, it's not being vulnerable to foreign threats and cybersecurity threats that not only results in theft, but also can result in something that, denial of service attacks or brings the system down. I think the one, lack of understanding, nascency of technology, lack of standards, lack of approved standards from the global bodies like NIST and ISO, for example. To me, these are some of the factors that are impediments in acceptance of technology by the regulators and by the system itself, because there are no standards. So right now, today, if you were to go and build up a payment system, there's a PCI DSS that gives you the entire recipe to say, we need these requirements in a system. And we have enough experience and enough talent to go and build all these things and say, okay, fine, you'll have a system ready in so and so date. But if you're able to spend more money, we can do it faster. Because at that point, you're throwing bodies because you know what kind of skills you need. Well, all that is missing today, right? So in a regulated world or in financial system world, which is not the case with crypto world moves on. There's innovation happening on a weekly basis in crypto world. There are new protocols coming. There's zero knowledge proof, and there's variation of zero knowledge proof that being adopted by layer twos because they're not constrained with the regulation. And we, as a result, pluses and negative, that they're moving much faster than traditional finance. But the negative side is they do have vulnerabilities. We see bridges being hacked. We see money being stolen. And I think what the system needs to be is, it needs to keep up to its promise of ensuring it's secure, ensuring that when Ganesh Ram is sending his funds and his assets, tokenized assets, there is some assured delivery of that. It doesn't get lost in the system, or you're putting your money in a protocol like you put in a bank. You have some assurance that it's going to be safe, and you can retrieve the money at your. So I think these are some of the factors that are contributing to delayed adoption of this, I think.
Yeah, we're very insightful there, Nitin. Yeah, so we have to be cautiously optimistic about this when because of the scale of economy that we are dealing with here. So my sort of last question here, in your expert opinion, see, I'm very happy that big enterprises are getting into this space, and we are seriously talking about tokenization. But in your expert opinion, how long we have for this to be the de facto standard, Nitin?
Yeah. So I always feel that you need 2 or 3 good success stories, and then it becomes exponential growth. We've seen the internet, right? There was a time when we had a starting trouble, and next thing you know, everybody had a website. Every bank had a website, and it all happened within a matter of a year. So there's this exponential growth. And I think we need 2 or 3 success stories, to your point, that if I can find a killer app that delivers value. And if you look at the recent announcement, PayPal and what BlackRock is trying to do, and what many of the large institutions are trying to do, is saying, let me adopt this, because one, this may be disruptive to my business. But if I adopt it and deliver the value that the technology promises, then I have a lead, and I can provide the same value that if Nitin can send using PayPal, paying a lot less than what I pay now to move money from United States to India, for example, then that's delivering value. And once PayPal does it right, then pretty much Citibank and every other bank will want to do that, because now they have a proven model. And if they can do that for fiat, can they do the same rails? Again, infrastructure, instruments, and insights. Can I replicate that infrastructure with a new instrument and apply the right insights that I need for KYC, ML, or any instrument-specific regulation that you need to follow? It's different regulation for bonds versus equities versus derivatives rates, for example. And then you'll find that suddenly now we are cutting and pasting these networks and creating new instrument, new assets. And as a bank, you still have the app and you're able to do all these different things, but behind the scenes, right? And so I'll say one more thing. Imagine the vision, and this is what my son taught me, because that's a whole new generation, and you should talk to your son about it if he's into crypto as well, is that new generation says, I have a wallet, and the wallet has cash. PayPal wallet has cash. PayPal wallet also gives you, for example, crypto. They also give you today a stable coin. And in future, you could have synthetic securities, an Apple stock. And you're going and buying coffee. And you want to be able to spend any of those instruments in your arsenal to say, I really don't like the stock. Instead of going and selling it, let me just buy coffee with it. But behind the scenes, you're going through a broker-dealer network. You're selling the asset, converting them to fiat, and moving the fiat into Starbucks account. I think that's profound. I mean, today you cannot do that. Yeah. You need all these different accounts. But if I can do that from a single, if you and me can manage our entire portfolio and assets through a single wallet,
wow,
right? I think that is the vision that we should aspire to do, which I think the newer generation is asking for it. And the question becomes, who's able to solve that complexity and not change any rules? We're not asking to change any rules and regulation, because the rules and regulation there to protect the consumers.
Yeah,
I think that's where I see this. So I'm looking at a horizon of 5 years for it to become mainstream, ubiquitous. Everybody's talking about it, which actually that conversation has begun from last 2 years. I would say 5 years as a time to understand, adopt, apportion money to build these things. And 10 years becomes just like what everybody has a website. Everybody has to have tokenized platform. That's how I see this industry at this point in time. Vishram.
So thanks a lot, Nitin. Your son's vision of being able to spend like that is mind blowing. The engineer in me is wanting to go code it now.
Well, we should meet up and think that. And next time we meet up, I worn the T-shirt. I love that. Of course, you're proud of Relevant because you're there, but it was nice that perspective.
Okay, very thanks. Thanks for your time today,
Of
Nitin.
course,
Wonderful insights as always. Thanks a lot. Thank
the
you.
pleasure was mine, and thanks again for having me, Ganeshram. I appreciate the work that you're doing. I appreciate the work that Relevance is doing for the industry, and looking forward to connecting again in the near future.
Thank you.
Okay, take care. Bye.